Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. Fixed income has been on a wild ride over the past few years. The Bloomberg Aggregate Index experienced its biggest drawdown in history a few years ago. And recently, Treasury yields have fallen despite differing macro signals. Well, I have on the perfect guest to discuss fixed income and the different ways to gain exposure to fixed income. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Mario Valente. Mario is the Deputy Chief Investment Officer and Portfolio Manager at the PSN Top Gun award-winning firm Stansberry Asset Management. Mario, thank you so much for coming on the show. It's an honor to have you on. Can you please tell us a little bit more about yourself and Stansberry Asset Management?
Sure, of course. Well, first of all, thank you so much,
Mhm.
Ryan, for having me and for having this discussion. Really looking forward to it. So let's get into it. So Stansberry Asset Management, we are a registered investment advisor, headquartered in Dallas, Texas, with offices in New York and San Francisco. The firm started about 8 years ago and really kind of was born out of this idea that there are a lot of folks out there that aggressively kind of self-manage their own portfolios. And so what we wanted to do at Stansberry Asset Management was create an asset management firm, right, that kind of curried favor to those types of individuals who are used to managing their own portfolios and really provide an investment philosophy or investment foundation for those folks such that they're comfortable bringing their assets over to us. So we actively manage their assets, and I think success has been pretty good so far. We've grown to about 1.1 billion in assets under management approximately over the last 8 years, and it's really a testament to the wealth creation that we've engendered for our clients. Myself specifically, I joined the firm about 7 years ago. I started my asset management career at a little known fund called Citadel in Chicago. This was, gosh, about 23 years ago. Was there for a number of years in their convertible bond and high yield desk, and really spent the next probably subsequent 15 years investing in corporate credit, fixed income for institutional clients like life insurance companies, pensions, and endowments. And 7 years ago, I was offered the opportunity to kind of to join Stansberry Asset Management, really kind of at the ground floor,
Mhm.
really when the firm was starting to really kind of start their trajectory path. And I was invited to come along as a deputy CIO, really with the intention of kind of creating a sophisticated but nuanced investment strategy for our clients, whether it involved investment sleeves like merger arbitrage, special situations, but also fixed income and corporate credit as well.
Fantastic, Mario. Well, you guys are doing some fantastic things in those 8 years, and it's evidenced by that growth. And like I mentioned at the opening, your strategies have won numerous PSN Top Guns. So fantastic stuff. Keep it up.
Thank
Um,
you.
you talk about fixed income. It's really interesting. For years it was kind of boring. Nobody wanted to talk about fixed income. But now, ever since the pandemic, it's gotten interesting. And, now we have rising inflation, stable economic data. The Fed is
Mhm.
indicating that they're going to keep rate policies on hold. Yet, Treasury yields have fallen recently, and the yield curve is inverted again. Can you please
Mhm.
help us make sense of this, Mario, and kind of the state of the fixed income space?
Sure, sure. So, it's funny. It's exactly what you described, Ryan. So, 4 or 5 years ago, no one, I would say, fixed income was kind of a ho-hum type asset class. And then 2022 hit, right? Where fixed income almost fell out of bed. And if you looked at the kind of the standard 60/40 portfolio in 2022, that standard portfolio was down, I think, high double digits, right?
Mhm.
Mostly, almost equally as a result of, negative performance in equities and negative performance in fixed income, right? And so I think that really woke people up to kind of the risks that are inherent in the fixed income space, right? And as a result, I think it led to a renewed focus on fixed income in 2023 and 2024. Okay. Over the last two fiscal years, we've seen fixed income operate, do pretty well, particularly investment grade and high yield. I think in high yield over the last couple of years, annualized rates of return have been just north of 10%.
Mhm.
So certainly equity-like returns, but in an asset class that has much better downside protection.
Mhm.
But in today's market, right? Today's market, I think you kind of hit the nail on the head. We've seen the 10-year Treasury yield kind of trickle down from its highs over the last couple of months, right? And I think that's probably telling us a couple of things. Number one, probably inflation and concerns are probably, subsiding a little bit.
Okay.
There's probably a little bit concern about weakening U.S. growth going forward. But also there's probably some optimism that the Trump administration is probably curtailing a lot of excess wasteful spend, which is contributing to enhanced creditworthiness for the U.S. government. So a lot of factors at play here, which has caused the U.S. Treasury, the 10-year yield to come down from about 4.8, 4.9 to currently about 4.2.
Mhm.
Um, and I would say presently it's a very exciting time to be a fixed income investor in today's space.
Yeah, I couldn't agree with you more there, Mario, because you get a lot of total return possibilities there, right? Even though,
Hmm.
like you said, yields have come down, they're still attractive. Before you mentioned 60/40 and before COVID in 2022,
Hmm.
yields were very low, right? And it was
Hmm.
a
Hmm.
40-year bull market for fixed income prices. Um,
Hmm.
and now they're attractive at
Hmm.
just over
Hmm.
4% still.
Hmm.
And you get some total return opportunities there too. So,
Right.
opportunities.
And
Yeah, go ahead.
Right. And I was going to say also, there's an interesting dichotomy right now going on in income, right? Because on an absolute basis, yields look very attractive,
Mhm.
right? I think let's look at the high yield market, for example, right? The 10-year treasury yields are, let's say, 4.25. I think the high yield index right now is right around 275 over treasuries. So on an absolute basis, you're looking at like 7% yields, give or take, right? High single
Mhm.
digits, which is much better value proposition than where we were 3 or 4 years ago in a very low rate environment. But the dichotomy that I'm talking about is corporate credit spreads are as tight as they've ever been, right? I think the tightest we ever saw corporate credit to today's environment was in the middle of '07, right? So about 18 years ago, which was, as we remember, was kind of the precursor to the great financial crisis,
Mhm.
right? And so the dichotomy is, gosh, on an absolute basis, high yield and fixed income looks very attractive. Conversely, corporate credit spreads are as low as they've ever been. So how do you kind of reconcile those two, right? I would argue, we should look at it in a relative lens, right?
Mhm.
So, okay, what are my other opportunity sets? Well, let's look at equities, right? Well, I think, equities right now, and this is probably before the sell-off of the last couple of weeks, PE multiples, it's the 10-year treasury yield was above the earnings yield for the S&P 500, right? We haven't seen that in a long time.
Mhm.
So relatively speaking, right, do I think there's better value propositions or better risk reward opportunities in fixed income or equities? I would say, it's not binary, but we're certainly finding a lot more compelling value propositions in fixed income today than certainly 3 or 4 years ago.
Yeah, that's great insight, Mario. So you talked about some where you're finding some value. What parts of the fixed income sector, or what sectors do you find most attractive? You mentioned investment grade. You kind of
Hmm.
mentioned high yield earlier. What
Hmm.
other spaces do you find attractive?
So there are really two pockets within fixed income that we find extremely attractive right now. Number one are in non-rated securities, right? So there's a large swath of fixed income securities that go unrated for a number of reasons, right? The issuer may choose not to pay at Standard and Poor's or Moody's
Yeah.
for the rating, right? They may think, okay, there's an institutional buyer class out there that already understands our business. There's really no need to pay for the rating. There's a number of different reasons why an issuer may choose not to pay for a rating, right? But the result is that oftentimes the market perceives an unrated security as more risky than a rated security, right? Kind of silly, right? But creates opportunity for folks who recognize that kind of I don't want to say arbitrage, but discrepancy, right, in yield. So if you look at an issuer that has an unrated piece of paper and may have very similar credit metrics to another issuer that has a rated paper, the yield on the unrated paper may be 50, 100 basis points wider only because it's not rated,
Yeah.
right? And also you have other dynamics at play too, where oftentimes, life insurance companies, pensions, endowments may be operating under strict thresholds such that they may be only able to purchase rated paper or have a very small sleeve allocated to unrated paper. So as a result, right, you have large swaths of buyers who are not able to purchase non-rated securities.
That's interesting. We have a lot of conversations about fixed income. Don't
Mm-hmm.
really bring up the unrated securities portion. So I'm really glad you did. That's an interesting segment that we don't talk a lot about.
Hmm. Hmm.
That fixed income space, and you talk about equity, fixed income space dwarfs equities, right?
Hmm.
When you
Hmm.
talk about treasuries and global and sovereign debt, and
Hmm.
then you just have corporate debt, dwarfs equities. And it makes it hard for an individual investor to potentially, and like you said at the very opening, Stansberry went to these clients that maybe did it on their own to go and buy
Hmm.
individual securities or issuances of fixed income. So they go the management, like Stansberry or other
Hmm.
firms, investment
Hmm.
management, buy, you know, a mutual fund or an ETF. What do you feel about active versus passive management? Passive is blowing up. ETFs, active ETFs, you name it. How's your view when accessing fixed income, whether it should be active or passive?
So that's a great question. We vigilantly believe that the smartest and most appropriate way to invest in fixed income is through an active management philosophy, right? For a few reasons. Number one, passive investors, passive managers, are oftentimes slaves to the ratings agencies. And what I mean by that is, they're not proactive, they're reactive, right? So when a security gets downgraded from investment grade to, let's say, to high yield, it crosses that triple B minus threshold, they're oftentimes forced to sell, right? And they're forced to sell usually at depressed prices. And then conversely, right, if a security gets upgraded from high yield to investment grade, right, they can now buy it, but they're oftentimes purchasing at high prices, right? So they're always kind of they're selling at the lows, buying at the highs, right? Over and over and over again because they're kind of bound by these ratings agency restrictions, right? That's a passive manager. Active managers, right? People like myself and my team, right? Our job is based on fundamental due diligence and research such that we can predict, or we should be able to predict when a credit is enhancing or degrading, right? So we buy the credit, we buy the paper before it's upgraded, or we sell the paper before it's downgraded, right? So completely the opposite of passive managers, right? And so you do that over and over and over again, right? It's been shown that active managers particularly in fixed income, can consistently outperform passive managers over 5, 10, 15, 20 years for that reason.
That's a great point. Normally, when I think of active versus passive in the fixed income side, I just think of like the egg. The egg
Mm,
is made up, I don't know what, 30, 40% of treasuries. I think even more, Mario.
hmm
You know better than I do, but it's a huge sleeve of the
hmm
Bloomberg egg is treasuries. And if you
hmm
buy passive index or ETF that tracks that, you're getting a huge overweight in treasuries. Do you really
hmm
want that? But you made a great point about being, reliant on the agencies, the rating agencies, and that's fantastic. And
hmm hmm
I also think too, as active management, with fixed income, you have to worry about so many other risks. You mentioned credit risk. You also
hmm
have
hmm
duration risk. And as
hmm
an active manager, you can manage that, correct?
Exactly. So that's a great point. With the ag, right? Because of their focus on mid to long-term treasuries, just like you cited, as well as having a pretty big sleeve devoted to mortgage-backed securities as well. The result is you have pretty large duration risk with the ag, right? Our view at Stansberry is with our bond strategy, which we'll talk about in a little bit, right? We want to minimize duration risk, right? So what that means is focusing on and selecting select securities that have relatively low duration, right? We're talking about maturities within a 2 to 4 year kind of profile or time maturity profile, right? We think that's the sweet spot, right? For not only for a number of reasons. One, you're curtailing duration risk, but also number two, once kind of maturities hit that 2 to 4 year window for an issuer, management teams become hyper focused on those liabilities, right? They're already starting to plan on how to satisfy a maturity that's coming up in 2 to 3 years, right? They're already planning their next capital raise. They're allocating capital for that piece of paper. And so as a result, right, we think the credit worthiness associated with short-term pieces of paper like that are almost for a large part of the market pretty much money good. So we'll continue to focus on that for that reason, but also because we don't want to have significant duration risk like the ag.
Hmm. Fantastic. So with that being said, do you focus, so you talked about duration. How about credit risk? Where are you guys, are you thinking more high quality right now with the
Mhm.
environment, or are you going out maybe high yield, which has lower duration? Where's your viewpoint in credit risk?
So right now we think there's pretty good opportunities kind of in the belly of the credit curve. I would say in the double B to single B space,
Mhm.
right? And those are for pieces of paper that are rated, right? For pieces of paper that are unrated, the market trades them like they're double B or single B paper, right? But in our minds, they should be investment grade, right? So the market penalizes them with increased yields, which is great for
Yeah.
people like us. So we can pick up those pieces of paper that are neglected or oftentimes thought by the markets as too much risk, and we'll add that to our portfolios as well. Right. Another kind of pocket of the fixed income universe, which we've been focusing on, and this is kind of very much a niche asset class, are busted convertible bonds, right? So convertible bonds very quickly are these hybrid instruments that have both equity and debt-like characteristics, okay? And what happens typically with the busted convertible bond is that the issuer's underlying equity has traded down in price. And therefore, the convertible bond has lost its equity sensitivity over time, right? And what happens to a piece of paper like that is typically the traditional buyer of a convertible bond is a hedge fund because what they do is they buy the bond and they short the underlying stock.
Mhm.
But as the stock goes down, right, they start to buy back that stock, and the hedge funds, attractiveness towards this piece of paper wanes, and so they sell it, right? They sell it, and so it creates this opportunity for folks like myself, where a lot of these busted convertible bonds are not rated, number one. And then number two, you have these hedge funds who are selling these pieces of paper as they lose their equity sensitivity. So as a result, right, it becomes kind of and apologies for anybody who's red-haired out there, but the red-haired stepchildren of the fixed income universe, right? Nobody wants them. And so that's great. That's great for managers like ourselves, where we can purchase these neglected pieces of paper from the busted convertible bond universe and hang on to them, right? And what happens over time is that the management teams and the issuers realize also that these pieces of paper have traded down significantly in price. And rather than create a share repurchase buyback, they'll create a bond repurchase buyback. So the issuers will buy back their bonds in the marketplace. And once we see that, right, that is a huge green flag for us because that tells us, number one, management teams are focused on satisfying this liability, number one. But also number two, it creates a backstop for the convertible bond, right? If you know that the management team is buying back these bonds at 85 cents on the dollar, well, that's great. Then they've set the price. If they'll buy there, I'll buy there too all day long. And that's a strategy that has worked for us for the last couple of years.
Fantastic. Well, Mario, you're not going to offend me by talking about hair or color of hair, so um, no worries, no worries.
Got it.
I mentioned at the opening that Stansberry has won, a lot of your strategies have won, been awarded PSN Top Guns, and we talk a lot about separately managed accounts here at Zephyr and
Hmm.
PSN and the benefits to them.
Hmm.
We think they're a great vehicle for investors who want more transparency, control, ability to customize, and it's just a great way to gaining active management also.
Hmm.
From
Hmm.
your viewpoint, as somebody who offers separately managed accounts, what are some of the advantages of leveraging SMA wrapper versus like a mutual fund, especially for fixed
Oh,
income?
right. Great question. So we only do separately managed accounts here at Stansberry for a number of reasons, right? We think number one, it's more beneficial for the investor for a variety of reasons. Investors own the individual underlying securities
Mhm.
in the separately managed account versus a mutual fund, right, where you just own a pool of securities. With an SMA, there's daily reporting that we do that our custodian does versus a mutual fund where reporting is quarterly or monthly. Um, we can oftentimes we can customize a separately managed account for a client. Oftentimes, we have clients that come to us with buy restrictions. Like, for example, I want a tobacco restriction, alcohol restriction, social media restriction, what have you, right? We can create that type of customization for the SMA versus, mutual fund, which really can't,
Yeah.
right? Also, I mean, I think the tax consequences are pretty significant, right? So end of year, we'll do tax loss selling, tax loss harvesting for our clients, right? Which certainly aids them and helps them versus a mutual fund, which really, can't provide that type of
Yeah.
service. Um, and then also, there's also the issue of leaving a legacy, right? So a lot of our clients, what they'll do is, for if they pass or for their spouse or what have you, right? Particularly in a community property state, you'll see a huge step up in cost basis,
Mhm.
right? To day of passing, versus for a separately managed account, which is great, right? Minimizing taxes versus a mutual fund, which again doesn't really offer that big step up in
Yeah.
cost basis. And then finally, a lot of our clients are focused on charitable donations,
Mhm.
right? So what they'll do is they'll gift a stock from their SMA that is appreciated in price. They'll realize the tax advantage associated with that versus a mutual fund again, which doesn't really offer that. So from our point of view, much more beneficial for the client to have an SMA versus a mutual fund.
Mhm. Yeah, I agree. And at Zephyr and PSN, we've done a lot of studies in, as generation, the generational wealth transfer, these younger generation of investors, they want more transparency, they want more control. And like you said, with your SMEs, it's reported daily. right? So
Mhm,
at
mhm,
Stansberry, you can see what you're holding. You can, if
mhm,
you don't want tobacco, you don't want guns, you can remove that. Whereas a mutual fund, you don't have a choice, and even ETFs, right?
Exactly, exactly. Whole host of reasons why we like and why they like SMAs a lot better than mutual funds.
Yep. And it's becoming more accessible. I think that's
Mhm,
the key, right? I'm not sure
mhm.
exactly, Mario, at Stansberry, what your minimum investments are, but when I got in the industry, it wasn't even an option. It was just all institutions, endowments,
Mhm.
but now it's getting out to where retail investors can get access to them.
And that's an important distinction. So I will say, for mutual funds, the threshold is a lot lower, right? For us personally at Stansberry, the account minimums are 100,000, right? So for a separately managed account, for some folks that's restrictive, for some that's not.
Mhm. Yeah. So with your SO Stansberry, do investors have to go straight through you? Are you on other platforms, or where can a financial advisor get access to Stansberry? Um, where do they start?
So great question again. We're actually on a few different platforms. So we're on the SmartX platform. We are on the Orion platform, and then we're also on the Advizon
Okay.
platform. So financial advisors, if they're looking for, I think on those platforms, we are those same accolades that you cited, Ryan, are also there as well. So if you're looking for those types of managers that have those types of accolades, you will see that on SmartX, Orion, or Advizon. So I would certainly recommend financial advisors to go there to find our products.
Yeah, it's fantastic. And like I said, you guys are having great performance, doing really good things. We see it within the PSN data, in my analysis when I'm looking at SMAs through Zephyr and so on. So great stuff,
And
Mario.
and and well,
Yeah.
this isn't the last PSA I'll say for our firm, but I will say this year, I probably one of the best years we've had so far in terms of performance. All of our 9 strategies are positive for the
Okay.
year, right? Versus the S&P 500, which is not. So it's again really a testament to the active management that we bring to the table that we think kind of is a differentiating factor versus other managers.
Yeah. Fantastic, Mario. Thank you so much. Such a fun conversation. You brought up some great points about the fixed income space that we don't sometimes think about. So great insight. Where can our audience get more information about your investment strategies in Stansberry Asset Management?
Sure, I would recommend just simply going to our website, www.stansberryam.com. Again, that's www.stansberryam.com. And I think in the upper right-hand corner, there's a Get Started link,
Okay.
which will bring you to a web page. You can fill out your information, and it'll offer you a chance to have a dialogue with either somebody from the investment team or a business development team in the next few days.
Fantastic, Mario. Awesome. Great conversation. It was an honor to have you on. Thank you so much. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel. And please give us a follow on LinkedIn and subscribe to that YouTube channel. Thank you very much and have a great rest of your week.
Thank you so much.